Crypto versus Forex trading, what you need to know. New ways of managing, transacting and investing our money continue to emerge as the financial world around us evolves. Let's start. One major change seen in the last decade has come from the rise of cryptocurrencies, or crypto, if you prefer brevity, digital currencies that lack centralized control but enable frictionless transacting and serve as a unit of account in a democratized financial system. This compares to the traditional fiat financial system, which relies on central banks and governments to issue and regulate the money supply while also facilitating transactions through an orderly payment system, among other responsibilities. Most countries have their own fiat currency or one pegged to an international reserve currency like the U.S. dollar or euro. When you exchange the fiat currency of one country for that of another on decentralized, over-the-counter markets, you call this a foreign exchange, or Forex. Both rely on laws of supply and demand to determine their price. But both have different risk profiles due to how they derive value. Fiat currencies have a measurable value, while cryptocurrencies are purely speculative, opines Justin Grossbard. A currency has broad-based acceptance as legal tender and use as a common medium. A cryptocurrency doesn't provide these same functions in that, with precious few exceptions, it fails to qualify as legal tender, doesn't come with backing from a government, nor comes with control of supply by a central bank. Cryptocurrencies rely solely on shared belief in their value between two parties. Market participants. But the nature of these assets isn't the only difference between cryptocurrency and Forex. Who participates in these markets varies as well. Governments play a role, as they need to ensure markets have the right liquidity to achieve their economic goals. Conversely, at present, governments represent minor players in the crypto market, though interest has risen for state-controlled cryptocurrencies. Banks and credit suppliers provide much of the liquidity to the market. Investment funds can use their excess funds or leverage to speculate or invest in Forex. Crypto markets tend to have smaller players and less institutional or governmental presence. According to data from Bitcoin treasuries, a much smaller share of the Bitcoin market has holders from governments, banks, investment funds and corporations than Forex markets. While Bitcoin isn't perfectly representative of the entire cryptocurrency asset class, we can at least get an idea of how little institutional or governmental organizations are involved compared to Forex. It's a small number. Less than 8% of all mined Bitcoin is held by these investors. To be fair, this only reflects Bitcoin held on balance sheets of publicly traded companies, private firms, institutional investors, banks and governments. More could be held in inaccessible Bitcoin, or Bitcoin that's been lost or trapped in inaccessible crypto wallets. But while this indicates a higher percentage of Bitcoins possibly held by other non-retail investors, the data still shows an overwhelming skew toward individual investors. Market size. Forex markets experience the highest volume of any market in the world. According to the Bank of International Settlements' most recent triennial central bank survey, as of 2019, well more than $6 trillion traded each day in these over-the-counter markets. Cryptocurrency markets have exploded in popularity over the past few years, but at the moment, they still enjoy far less volume and activity than Forex markets. Total combined daily crypto market volume was $1.3 trillion as of September 2021. Hours of operation. Forex markets see daily trading 24 hours per day, 5 days per week. Crypto markets not only see the same type of non-stop weekday activity, that action extends to weekends as well. Market structure. Where crypto versus Forex trading converges is on how these assets trade, over the counter, directly between parties, through a broker or exchange. This means traders negotiate pricing based on supply and demand without governing oversight. Stocks, on the other hand, trade on organized exchanges like the New York Stock Exchange, Nasdaq or other national bourses, and carry stricter issuance and disclosure rules and guidelines. Accessibility of assets. Because these assets all reside in different markets, you might need different brokerage accounts and systems to access them. For example, Coinbase is limited to crypto offerings, while TradeStation and Interactive Brokers allow you to invest in cryptocurrencies, Forex and stocks. If you decide to use an investing app to trade crypto, you might not have the ability to withdraw your cryptocurrencies to crypto wallets, or a secure place to store your private keys tied to your unique coins. If you wish to withdraw your virtual currency to a crypto wallet, dedicated cryptocurrency exchanges such as Binance and Coinbase allow you to do this. Trading pairs. Yet another difference between Forex versus crypto trading is the use of trading pairs. When you trade one currency for another, say, US dollars for euros, the exchange will show the value of one currency relative to another. For example, when looking to trade USD for EUR, you might see a quoted price of $1.20 to buy 1 euro. This means for every euro you buy, it costs you $1.20. In Forex, trading pairs that involve the USD are called currency pairs. When pairings don't involve the USD, these are called currency crosses. In crypto trading, technically the same logic applies. Crypto trading pairs, or cryptocurrency pairs, involve trading one crypto for another, such as Ethereum/Bitcoin Cash, ETH/BCH. Trading pairs in crypto matter because some cryptocurrencies can only be bought with other cryptocurrencies, making knowledge of these pairs necessary to expand your crypto holdings. This gives investors a chance to arbitrage between trading pairs as well as compare the relative worth of coins. How do regulators view crypto versus Forex trading? The U.S. does not currently provide for comprehensive oversight of cryptocurrencies. Instead, it relies on a hodgepodge of regulatory supervision. In 2014, the U.S. Commodity Futures Trading Commission, CFTC, classified virtual currencies as a commodity. This decision makes cryptocurrencies subject to regulation by the CFTC when used in the context of a derivatives contract or if evidence of fraud or manipulation occurs in interstate commerce. The CFTC regulates cryptocurrencies through the Commodity Exchange Act, ECA,